Dave Ramsey digs his heels deep when it comes to investing in mutual funds, particularly those of the growth stock variety. He's often heard championing four specific types: growth, growth and income, aggressive growth, and international. Now, what's interesting about Dave's philosophy, at least from my vantage point here in Portland, is that it's clear-cut. No confusion, no jargon, just a straight path he believes leads to Wealth Mountain. But there's always some fog around the peak, isn't there? Let's break these funds down a bit. The Growth Fund is the all-American hot rod. This fund is buying stocks in companies that are expected to grow faster than the rest. The Growth and Income Fund is a touch more conservative. Think of it like a sturdy pickup truck. Reliable, not as flashy, but can definitely haul. Aggressive growth funds are the risky sports cars. High potential gains, but you'll feel every bump in the market. And lastly, international funds are your all-terrain vehicles. Foreign stocks can ride over ground the S&P 500 doesn't cover. Now, the million-dollar question: can any of these consistently outperform the S&P 500? Well, that's tricky. First off, the S&P 500 is often the benchmark for the market because it's a broad snapshot of the cap-weighted performance of 500 large U.S. companies. It's like the baseline health of corporate America. Some mutual funds do outperform the S&P in the short term, but over the long haul, it's much, much tougher. A big reason is fees. Those pesky little percentages tagged onto mutual funds eat away at returns like termites in a wooden house. Then there's the issue of market efficiency. The S&P 500 is well studied, well analyzed, and it reflects a lot of collective wisdom about those top companies' values. That being said, some fund managers have outperformed the S&P 500 over significant periods. Names like Peter Lynch come to mind. However, they're not exactly the norm, more like shooting stars streaking gloriously over a generally predictable night sky. It's also worth noting that any given mutual fund could have a spectacular year or two, only to trip over the next market anomaly. It's a roller coaster, not a scenic train ride. In the end, investing isn't one size fits all. Dave's got his picks. Others might point out indexing as the lower cost, less stressful path. Me? I advocate for doing the research, understanding the risks, and maybe diversifying across a few different strategies. Oh, and keeping an eye on those expense ratios. The less you pay, the more you keep.